Awesome. Hello, everybody. Thanks, Jenny, for the kind introduction. As Jenny said, we're in the education business, and at Least Cake, it's so important to share stories, ideas, advice across the industry to help you. We definitely want to keep this interactive. It's a lot more fun that way, encouraging your questions. And my name is Taj Adham. I'm the founder of Leasecake 7 years ago. We're coming at you from Winter Park, Florida, and this is our cake quarters. We feel like the best conversations happen around a table in the kitchen, as it were. And in that spirit, I'd like to welcome our guests to our kitchen from Citrin Cooperman, two gentlemen that if you don't know them, you probably should. They're experts in the accounting industry. They're the partners and co-leaders of Citrin Cooperman's franchise accounting and consulting practice. They've seen quite a bit of growth themselves at Citrin Cooperman, having been acquired by Blackstone, and the growth they've seen has been astounding, and you'll hear about that here momentarily. I met them 6 years ago, so please welcome one of our guests, Aaron Chaitovsky.
Thank you, Taj. Thanks for having us on here. We appreciate the opportunity to talk franchising and to hopefully leave some points that people could take with them, some gems that can help them not have some of the pitfalls that are out there.
I love it. I love it. And last but not least, Michael, you and I met like in New York City. Michael Iannuzzi, welcome.
Thank you. I love the way you say my last name. That is the Italian way to say it. So thank you for that. And yes, we met 6 years ago at the Red Flame Diner for breakfast before the Franchise Expo when you're getting ready to launch this thing. So it's been great to watch you where you are today and how you grew Lee's Cake into the kind of monster it is today.
Oh boy, you're too kind. But your story has been phenomenal because when we first met, I mean, Aaron, you might want to take this. You were, the largest CFE or franchise practice in the industry as a CPA firm, but you were small, and then you continued to bolt on more and more firms and got larger. Tell us a little bit about your background, how you got started in the industry, and kind of what fuels you.
Sure. The short story is a little over 40 years ago, I had a little small franchise, or there was a client of ours. Some of you may have heard of it. It's called Subway. And when I first got involved with that company and Fred DeLuca, there were about 100 locations, 120 locations at the time. And I think at that time, Fred was just making a profit. Uh, I was able to work with Fred for almost 38 years. And as he grew, we were able to brainstorm with him as franchise was being regulated in the 80s and 90s. And up until the point he passed in 2015, worked for another couple of years with them till they were 45,000 locations in 120 countries. So we were able to see a lot of the growth, work with him, and had a front-end view. Early on, when I was working on the account, Fred said, "Hey, you should get more involved in the IFA. There's so much more to franchising. Why don't you come?" And of course, my answer is, "Well, we're busy doing your work during that time. For accountants, it's a terrible time." But he had said, "Listen, why don't you come and I'll introduce you to people?" So I went, and he did. And the reality is, it was through that intro, I just fell in love with what was going on in the franchise community, and got to meet a lot of very, very positive thinking individuals, a lot of entrepreneurs, and we started attracting people the more knowledge we had in franchising. I was fortunate the last 20 years that Mike had joined our franchise committee about 20 years ago and moved up very quickly, worked on the Subway account with me as well, and definitely was the future of our franchise practice. As I was getting older, all of a sudden the franchisors, younger people, needed some youth in there, and Mike joined, and he's been the co-leader with me for about 6, 7 years, and I'm happy to say that beginning July 1st, he will be the leader of the practice going forward. Yes, this is the first place you're hearing
This
that.
breaking
Yes, this is
news.
breaking news. Breaking
Wow.
news. He'll be the leader of it, and he is taking us into the next generation, and he's already done that so well in the last couple of years, and it's heading that way, and looking forward to see our practice keep growing in leaps and bounds, servicing franchisors and multi-unit franchisees.
Wow. Well, we're honored. You heard it here first, Least Cake Live. But Michael, man, what an incredible career arc that you've had. Fantastic. You got to share, your beginnings, obviously working with Aaron. the things that you've been doing, the customers, your clients, the experience that you've seen, all sorts of, good news, bad news stories. Give us your background.
Sure, sure. Well, I did not expect to hear what Aaron said today, so that's that caught me a little bit
You didn't know you were
off
getting
guard.
promoted until just
I
now. Is that
had
right?
ideas, but no, I did not know for sure. So it was good to hear that. Well, thank you, Aaron. As many people have heard me say forever, and other people on our team as well, Aaron is all of our work dads. And so that's how he's been for 20 years that we've been side by side, working together with each other. And so, a lot of our credit is due to Aaron and his leadership. I've always been kind of in love with franchising, the restaurant world, and kind of how that all worked. This is a true story. I've been working since the age of 9 years old in my uncle's pizzeria, making boxes in the basement, and just kind of went all the way through, went from restaurant to restaurant. In college, worked on a franchise plan, and how to roll out a multi-unit operation. Came to the firm and they said, do you want to work on the Subway account? And I'm thinking it's like, one or two locations, and they say, no, we handle Subway worldwide headquarters. Will you travel and sleep away? I said, yes, please. And spent, 15 out of my 20 years here on that account, kind of learning everything there is about franchising, got involved with the IFA, went to my first conference, was actually in Orlando, and just kind of was blown away by the energy at that convention, all the brands, the people running around, how free people were with information and to kind of take you under their wing and help you. And learning all of that is how we're trying to build the team internally, making our team members very open with each other, mentor each other, help each other, sit down with them. There's no such thing as a bad question. If they don't understand something, sit with them again, teach them. This way they can do that in the field and train the next generation of people that are coming up.
Wow, that's great to hear. You guys are very supportive and simply want to do nothing other than help and get people ready. Talk about the number of firms that have kind of been bolted on. Like how many uh, professionals do you have now, and how big is Citrin Cooperman?
Well, I'll take the first piece of that. I mean, Citrin Cooperman as a whole is about a 3,500 to 3,800 person firm, which has been lots of acquisitions over the last 20 years. I mean, Aaron may know the number, but it's got to be over 60 acquisitions. And as the firm has evolved into what it is today, we're separated by different industry practices. So, of course, franchising being one of them. And as we've been acquiring firms that are specialty areas, like valuation, due diligence, litigation support, software automation, things like that, we've been kind of speaking to all these groups as they come in, having them educate us, the legacy Citrin Cooperman people, and say, well, tell us what you do and how can we apply what you do to our client base to help make them better and help them grow into the future.
Aaron, you want to fill in any blanks here?
Yeah, and yeah, when I joined the firm, 28 years ago. I merged into Citrin with our firm, and there were 70 of us back then. So we've grown tremendously since then. I've witnessed over 60 acquisitions over the years, and they're acquisitions that blend in. They're all strategic, as Mike said, and we're a very entrepreneurial firm. We're not your typical accounting firm. We don't just do accounting work. We actually have to understand our clients. We try to understand what they want, not tell them what they want. And it's worked out very well that we've decided early on that we'd like to be that one-stop shop for our clients, where we understand their business from the accounting and tax side. Now they need consultants, they need advisory services. We know their company. We know how they make money. They know what they look for. And we try to match the consulting services to what they need. And by adding all these ancillary services to our firm, we've been able to add so much more to what we could provide to a franchise or a client. We're not just accountants doing audits.
Right.
So that's worked out very well for the companies because they know we understand it. We understand the FDD. We understand how they operate. We understand franchising. We stay abreast of all that's going on, whether it be accounting or tax affecting franchising. And we see what's going on in the economy right now. And I will tell you, years ago, everyone's dream was to build a company, take it public, raise a bunch of cash, make a bunch of money, maybe exit because you took it public. The regulations regarding public right now have gotten so stringent and so difficult And the private equity firm is the way to go. That's replaced people going public. Franchising as a franchisor, if it's done correctly, can actually be a cash cow, not typically started because you're trying to raise cash.
Right.
Cash flow at a certain point is not your problem.
Sure.
It's growth. It's how do you take this to the next level? And what can you do with your franchise system? And that's where the private equity firms coming in, they're able to help you acquire other companies and grow your practice that way. And the good thing is, depending on how the private equity firm comes in, you can retain a piece, stay involved, or not. There's a buyer for both types, and sometimes it's the answer for actually part of the succession plan.
Yeah.
A lot of people say I want my kids to take over the business. They may not want it.
Yeah.
You know,
Well,
it
let's
doesn't
just
work that
pause
way.
there for a second because you added a couple of key points, which is all the acquisitions that you've made at Citrin Cooperman have been strategic. But then I'd also add that I think Blackstone's acquisition of Citrin is also incredibly strategic. And it seems like you all have been, witness to that firsthand from, 5, 6, 7 years ago. So is it correct to kind of start to say that you all are like a platform to add value to the Jersey Mikes, the tropical smoothies, the Seven Brews as an accounting system for them to continue to grow? I mean, not just for their portfolio, but for others as well.
I can't talk about what Blackstone is thinking. I could just tell you what attracted us to them
Yeah.
was the fact that we are definitely very far advanced when it comes to staying in line with AI and the digital world and what's going on in the industries.
Yeah.
And they're very excited about all our advisory and consulting services.
Fantastic.
As an auditor myself, the audit is a necessary evil. It's a commodity. If you sell it as a commodity, you know what? Everyone's going to look for price. We hate when we're put into a box as a commodity,
Yeah.
and it shouldn't be that way. It should be what can I do that I actually have some benefit from the accountants that I use. And I think they were very much attracted to the various consulting and advisory services that we keep adding. Once we bring something on, we try to find ways of growing that particular industry or that particular service, whether it be valuations. I remember years ago when we started our valuation service or the Q of E service, quality of that our transaction advisory services, there were two people in the group. Got a team of 50 now. And we actually have, of that 50, we've got a dedicated set of people just focusing on franchise.
Yeah.
So we're growing those services as best we can to service our clients. And look, we'll be the first to say that we're not the right fit for every single company.
Sure. Well,
What we bring to the table, we know what we know, okay, and we know what we don't know.
yeah.
So we stick to what we know, and we actually if it's not a good fit, then we'll be the first to tell people that maybe we're not the right firm for you.
Right.
And
Well,
that's how we've operated. And it's as Mike said earlier, we have different divisions of the firm, probably about 12 or 15 specialty areas. The firm's been extremely supportive of our franchise practice because it is probably one of the most entrepreneurial parts of the firm
sure.
and
Well, let's talk.
practice because of the industry.
Yeah, let's talk about the client advisory services. We've heard these stats, and Michael, you could probably attest to this. Audit grows at roughly 5% a year, tax probably 10% a year, but client advisory services, where it really gets into how do you get ready for a transaction? How do you make sure that you've got all of your operating systems in place? Why is getting ready a competitive advantage and not just like, oh, I think I'm ready? Michael, why don't you take this?
Yeah, and if it's okay, Taj, maybe I'll just touch on what a quality of earnings report is, because
Please
David
do. Yeah.
mentioned that, because that is really one of the first steps in getting ready. So yeah, I mean, the competitive advantage of getting ready is being to the punch and understanding really what is involved in your business, making sure all your documents are matched up, all your leases are accounted for, running through something like LeaseGate, whether they're favorable, unfavorable leases, market, not market conditions, things like that. But as people are getting ready, if you're on the sell side, most likely a private equity firm is going to ask you, or they're going to conduct their own quality of earnings report. What we like to do when buyers are really preparing for the future is let them do the quality of earnings report first. This way, you already have the sell side package prepared, and you already kind of know what the PE group is going to ask for once you have that report prepared. So, in its simplest terms, a quality of earnings report is really what your adjusted future, EBITDA is going to be. So, a lot of people say, well, I have an audit. Well, an audit is the GAAP, generally accepted accounting principle, net income or net loss. That's the number. Whether or not you had bad expenses in there that were not recurring or whatever, that is the number. The Q of E is going to start with that number and it's going to adjust for things that maybe are not recurring. Maybe you had a big litigation case that took place and it was $1 million. Well, that $1 million is not recurring. So we're going to add that back in the quality of earnings report to bump up your EBITDA. Maybe you have a bunch of units sold but not open, but they're going to be open in 6 to 8 months from now. So we're going to apply some sort of run rate on the royalty if you're on the franchisor side that you're going to receive from those sold but unopens. And we're going to add that to the Q of E to bump up your EBITDA. So there's lots of things that go into it, but it's really for people to prepare and get a handle on the business and what a buyer is going to look at. And it's much better to know in advance than to be surprised later when they're asking you for all these questions and you're digging through your files and you can't find the
Right.
answers.
Yep. There's a due diligence checklist that we'll share at the end of the webinar, but it sounds like you shouldn't wait to get ready. You should get ready now. I mean, would you agree with that, Michael?
I would say at least 2 to 3 years in advance if you know this is something that you want to do.
Yeah. We've seen our customers kind of using LeaseCake as a data room, as it were, keeping, I mean, all the things you just talked about, not just quality of earnings, but your corporate information, tax returns, and the like. What are some of the other examples that would be in a due diligence checklist, Aaron?
Well, it's put very simply. The Q of E, the quality of earnings report, it's called normalized EBITDA, and anybody who's buying a company is going to look to do a multiple of that number. So, like Mike said, if you have a GAAP number, they may just take the number from the financial statement, which we know that's just what happened this particular year or last year. It doesn't really explain how the company operates. So, two things that kill a deal is seller's remorse, which I'll put that as number two, because you got to make sure you got a willing seller. And the second is surprises. And the idea of the quality of earnings is to make sure you don't have surprises. Make sure your IT department is working correctly. It also make sure you're tracking how the franchisees are doing. They're reporting, how are they reporting back to the franchisor? It makes sure that your books and records are actually using GAAP accounting. And I'll say something that's very sad about the profession. There is specific standards you must follow when you do an audit. Just like there are many consultants, attorneys, platforms that may not do everything according to standards. There are accounting firms out there that, whether they have enough support or whether they keep up with, especially on franchising, to understand GAAP accounting with franchising. And sometimes those audited statements need to be corrected and the company has to be brought up to GAAP. So that's all done to avoid surprises. And the Q of E is a very, very in-depth accumulation of information. They're not opining on anything. They're taking the information you feed them. And as Mike said, and you said earlier, Taj, that data room, tracking leases, tracking franchise agreements, tracking all the information. Look, leases has a tremendous impact on accounting, how those are treated. You need very good detail on that. You need to know that if you're buying a company, you need to know about renewals. You need to make sure there's all at your fingertips and there's no surprises. You need to know that someone's tracking CAM charges on rentals to make sure that you know if you're going to have a big outlay of capital expenditures as soon as you come into a company. And it sounds like, oh, we always cover this with a due diligence. These are things that are going to fall through the cracks unless you follow that quality of earnings report, as a prep. And the good thing is, like Mike said, it could be 2, 3 years earlier before you're looking to sell. The idea is you could fix things. You do a quality of earnings report today and you see how your company's operating. First of all, it gives you information about how to run your business better. You have a better handle on things. But now you know what to target to fix the next year or two before you actually bring it to sell to bring that number up.
Yeah.
And it helps them run it. And it very often it helps a seller truly understand what their business is worth. If I said to you, Taj, you want to sell your business for $10 million, you may say, wow, 10 million sounds like a lot of money. But for all you know, your company's worth $25 million.
Right.
If you actually looked at it, it could be worth more. And the reverse is also the same. You may think it's worth $25 million and you need a little reality check if you're going to go out into the market, or you're going to be very disappointed and spend a lot of money for all the wrong reasons and not have a buyer.
Yeah.
So it's helpful for it's helpful for the seller, obviously. It gives you more of an understanding of what it's worth. It'll help you understand whether now's the right time to sell. And really getting your house in order, people usually wait till the last minute. I mean, Mike and I can tell you how many clients we have that they want to go sell the company, and the attorney never filled in the corporate documents or the operating agreements. And you're going back trying, does anybody know where this contract is? I know we signed something somewhere. That doesn't fly when you're selling, especially to a PE company.
Mm-hmm.
So it really gets your house in order with a lot of these documents.
Yeah.
So,
So
Taj, one of the things
go
I would
ahead.
add, I'm going to put you on the spot because maybe at least Kate can do this in the future, is
Okay.
especially on the multi-unit side, the refurb requirement, how many years it takes until you have to actually redo your gym or your location. And so when you're a large multi-unit operator, that refurb requirement could be massive in the
Oh
future.
yeah.
So that's all going to come into account when valuation and multiples are being worked out. So I don't know if there's something in the future in your system that you can do where you're tracking when the refurb requirements need to come in. This way, if you have 50 locations, you're getting alerts on your software as to when these things are coming due.
Yeah, no, absolutely. We do that today, and I'm glad you
Yeah.
asked, because the notion of having a data room ready, it's kind of like planting a tree. When's the best time to plant a tree? 20 years ago or today? Because like you said, Michael, you should prepare for a transaction, because ultimately you want your legacy to be passed down. You want to make sure that you're prepared, and having that type of a data room that certainly we could provide, but having a data room helps to protect your multiple, or maybe even provide a little bit of ratchet to increase your multiple, because every transaction is competitive. And so any PE firm or anyone that's willing to invest in your company, even at a minority interest level, they're saying, we kind of want to invest in these guys faster because they're ready, as opposed to this company. Like, I think
Yeah.
all the right pieces are there, but it's just like pulling teeth.
Yeah.
So a couple of things that just to kind of reemphasize on the franchise agreement perspective, we've seen customers that don't have the franchise agreement dates coterminous with the lease dates. We've heard horror stories where uh, the lease is expired, the franchise agreement's expired, but somebody has continued to operate and sell sandwiches or sell pizzas, and they don't even have the right to do so. So it's just really,
Yeah.
bad business. But the refurb cycle, or the brand refresh cycle every 5 years, a complete refurbishment every 10 years. You're right. It's significant, whether it's 500 grand or 2.5 million. You got to plan for it. And it's more than just saying, oh, hey, we've got all of our leases in order and here you go. But there's the devil's in the details. There's so much that you got to really consider. So you guys have seen, I'm sure, some success stories. But are there any like gotcha stories that you can share to the extent that you can?
We'll make Aaron be the bad guy on the bad stories.
Yeah, that's right. Yeah, Aaron will be the bad guy, and you
I've
can be the
I
actually,
good.
only tell you the good ones.
I will tell you, seller's remorse is always that does come up when someone's all set to sell at last minute, no matter price right or not. They just decide, what, I'm not comfortable selling. Some of the disasters we've seen have related to the C-suite team not buying into it or thinking they're going to stick around, and some of the people are key. Very often, somebody's selling may have the wrong people in those positions. That's very important. Um, Look, a private equity firm coming in scares the heck out of the corporate employees and the franchisees, especially one coming in that's going to make drastic changes right away. It scares franchisees. That's been an issue. When do you tell the franchisees this is happening? You can't tell it too early. You can't tell the employees too early because you don't want to be in a situation where you're scaring them and they run. They're
Yeah.
very happy working in a family business. I'm not ready for a corporate environment. It's going to change everything. I don't want to be a franchisee in a system like this where I'm a small, cog in this whole massive company. They're not going to look to us the same way. And look, we are in that situation at Citrin Cooperman. We're owned by a $1 trillion company. Company's got $1 trillion under assets. We're as valuable as we are, they still have $1 trillion. It's a lot of money. Um, and you do look at it, and we were very comfortable though because they actually are very sincere. The team working with Citrin is very sincere, and private equity firms, they come in for three reasons. Okay, they're very interested in seeing cash flow come through when they come into a company. They want potential growth, and they want opportunities to expand. Those three things. So they're going to look to them. If you've got a family-run company, a franchisor that's a family-run company, that it does get tired and does get sleepy after a while, you're the perfect target for them to purchase, and you could do very well with it. You can even have opportunities where you could share in the future growth. They're flexible that way. We've seen deals fall apart because of the tax structure. Okay. A little simple thing that happens is a lot of franchisors are pass-through entities. And depending how the company is purchased, we've had issues with, let's say you're bought in the middle of a year. That means the person who runs the tax return is the new owner of the company. And all of a sudden you own the company for part of the year. They own it for the second half, but they control the tax return. If you don't deal with that up front, all of a sudden you get hit with taxes that you have no input on, and you can't sign returns at that point. You don't have that authority. So making sure that's covered. How you structure the acquisition is very important to make sure you take advantage of long-term capital gain treatments in a lot of these things. These become very big issues, and they can amount to millions of dollars in a transaction.
Absolutely.
I think that Mike touched on the refurbishment and the gap situations before, but the reality is it's surprises are the worst killer of anything. Todd, if you go to somebody and say, hey, you're going to lose $100,000 next year, and they lose $100,000, they'll be disappointed. If you tell them to break even, they lose $100,000, they're going to sue you.
Yeah.
That just because they weren't expecting that. And I
Yeah.
think that transparency on a sale. Everyone thinks when you sell something, oh, I hope they don't find it. I hope they don't find that. Terrible attitude of going into a sale, of selling a franchise system. If you feel that way, you're not ready to sell.
Yeah.
Okay. The idea is not to try to hope somebody takes us out of our hands because there's serious problems here. Be honest, work with them, and we find those deals are the smoothest deals that go through. A lot of them, we have the franchisees see opportunity. That's a great situation. Very often, employees, the key employees, are part of the deal and have these kind of like golden handcuffs. They know they could do so much better if they just stick around,
Mhm.
and rightfully so. That's always very good. And I also found a lot of the franchise ones that work well are the ones where the franchisor or the PE company is not looking to make drastic changes overnight.
Sure. Exactly.
They want to take a step back. Let's see how the operation runs. Let's get some feedback from franchisees, from the franchisor, see how it's operating, and then gradually make the changes with the franchisee buy-in.
Yeah, we've got some questions coming in, but before we go to that, Michael, why don't you share, some of the positive stories?
Positive story. I'll add two quick things on Aaron's side. The tax being number one, tax due diligence. Are you filing returns where you're supposed to be filing them? Are you doing all your sales tax returns appropriately? Are you doing all your payroll tax returns appropriately? Like all this stuff will come out in due diligence. And so the buyer is going to hammer you if these things are not done. Second thing is these agreements are very, very thick. And as the seller, you need to be aware of all the covenants you're responsible for, like hitting certain equity thresholds, EBITDA thresholds. They could be clawback requirements where you're losing some of your equity if you're not hitting these numbers. So you got to be very, very careful with what you're looking for. On
Okay.
the flip side, though, if you have a very good relationship, good cultural fit with the buyer, the success stories are unlimited. I mean, there's so many examples of private equity coming into a multi-unit franchisee or franchisor and just putting fuel on the fire, and the unit count just explodes.
Yeah.
So you have to be ready for that type of growth, and you have to have that plan in place for what you're going to do with the money when it comes in to be ready for the growth. But on the flip side, I mean, when it works well, it works really well.
Yeah, absolutely. I mean, if you look at what Rourke has done, Rourke Capital's done, $40
Right,
billion fund,
right,
just closed on Dave's Hot Chicken, one of our customers
right.
yesterday. And I mean, they've got a great track record, as does Blackstone, and, as does KKR. I mean, you can kind of go down the
There's
list,
a
but
bunch of them. Yeah.
there absolutely are. So just getting into some of the minutia of valuation, and these are some questions that came through. So there's another Michael here on our call today. It has to do with, as a franchisor, corporate stores and franchisee stores. Um, what, are they kind of considered the same from a valuation perspective, the EBITDA of both? I mean, obviously, you're not here to give advice, but just wanted to touch on that. And then there's a follow-on question. What do you think,
Yeah, I can
Michael?
start that one.
Yeah, so absolutely not. They're looked at very differently. The franchisees, because there's less investment on behalf of the franchisor, the ROI is looked at very differently. That's cash flow. If you look at a company on location, they're going to look very closely at how much is invested in that store, the brick and mortar, what the assets are doing for the franchisor to get that return. Now, there are companies out there, PE companies, that love looking at the top dollar. They're all looking for gross sales. So a lot of companies, franchisors are trying to build company-owned locations so they have a much higher top dollar. You know what? There are companies out there. I think if you're focused on franchising and understand the franchise model, I would think that a majority of them in the franchise field are not looking for large quantities of company-owned locations. Unless you're looking to be a multi-unit franchisee.
Yeah. Okay.
But I think that that has a lot to do with it. And one key comment that I have to say, and it's really something to really focus on. Just like, I tell people all the time, don't use an accounting firm that does franchising. Don't use a lawyer that does franchising. Don't use consultants. Don't use a company that monitors leases that does franchising. Use a franchise attorney. Use a franchise accountant. Use a franchise consultant. Somebody that's their focus. Okay. People who do this dabble in franchising are not going to help you. And franchise and a lot of PE companies, like you say, Rourke Capital. Rourke Capital is brilliant in what they do. They know franchising. They understand the model. They understand what makes sense, what doesn't make sense. A lot of PE companies that we come across may have one franchise or they're learning off that one. And the first deal may be a great deal, may not, but they go into it probably with the wrong information. And there is an industry here that franchising is a way of doing business, and people think, oh, I could do franchising. No, you have to understand franchising. And I think if people are using the right attorneys, consultants, accountants, companies such as yours that focus in franchising, I think they're going to find so much value in bringing it to the
Yeah.
table. And again, avoiding those surprises. It's everything's
Yeah.
all about the surprises.
Yeah.
And build your company to sell. I always tell people you want to build your company to make money, not to sell. But when you decide it's time to sell, you want to make sure that you give yourself a runway to actually fix some of those things, find out as soon as possible what's going on.
Yeah.
And I understand Michael asked a question about valuation. Valuation and Q of E are two different things.
Yes, exactly.
Yeah. So the Q of quality of earnings is to find the normalized EBITDA. Whether you're 3-time multiple or 5-time multiple or 6-time multiple, that's a valuation. That has to do with industry comps, making sure something's not a fad item. And that's really they're looking to see, is this a company that if I threw a bunch of cash at it, they could
Yep.
really ramp it up?
Well, I tell you, the questions that are coming in, there's definitely, listeners in our audience, in our community that are thinking about transactions and they're getting ready. So it definitely, this is a 1 hour conversation. We could talk for days.
Yes.
And we'll definitely be connecting, anyone in our audience that wants to meet or have an intro conversation with these two gentlemen. We'll happy to facilitate. So what about driving up demand in today's market for a potential buyer? I mean, any tips or tricks you've seen? I mean, I know that like large caps are not as active as they were in the past. I mean, there have been a few big transactions, but mid cap and kind of lower to mid tier PE firms, I'd say, are more active. But have you seen any uh, tactics or approaches that have worked to get interest of PE or a potential buyer?
Yeah, I mean, being number one, just actively involved in the franchise community is
Yep,
huge because there are so many conferences and educational webinars just like this and in-person sessions that are going on that as you're at these places, number one, you're going to be meeting the people who are doing the deals and you'll be
sure.
making
Yep,
one-on-one relationships with them right away. Sticking on the topic of hiring people involved in franchising, there are very specific franchise investment banking firms that are out there. All they do is franchise deals, and they're the ones that are pulling together the slide deck, the pro formas that they're sending out. They're incorporating the Q of E or any valuation reports that are being prepared. They're sifting through the data room. They're sifting through all the leases. They're sifting through your software. They're the ones that are putting the story together to drive up demand and bringing, your concept to market. There's just something about franchising though over these last 10 years or so. People love the franchise model, both sides,
sure.
the franchisor, franchisee, and now the suppliers. There's
Yep.
been a number of franchise suppliers who've had private equity investment over the last couple of years. So there's something about this community, the way it kind of comes together, the way people share information with each other, competitors talk to each other to share best practices. So putting this all together and being present out in the field is going to help drive your personal demand.
Yeah, I'm glad you brought that up because we do live in an ecosystem, right? This is a very important
Yeah.
franchise ecosystem. Within our network at Least Cake, we have a host of investment bankers and transaction advisors that we happy to connect to anyone if they're potentially interested. And I'm sure you know many of them. So we exist solely to help this community and kind of transform how business is done. I'm glad you touched on that, Michael. So let's see. So we talked about demand, getting active. You got to be in the arena. Another question. Let's.
And let's
Oh, is there a little feedback?
A little bit, yeah.
Okay. Let's see. Valuation multiples. Mike, another Mike in our audience. When valuation EBITDA multiples are shared or published, what are the most common approaches that have been used to generate those published multiples in terms of present versus future value? It's a pretty in-depth question here. Um, like who's the creator? Like, oh, this is the report. They created the standard. Um, what are the most common approaches to like look at valuation multiples, as comps, I guess.
So I'll hit a little bit, then Aaron can jump in on it. I mean, that's a whole separate specialty, where those valuation people have their own designations and certifications to use the various different methodologies like the Black-Scholes model and stuff like that. Now that's valuation.
Yeah.
And then there's what we said earlier, quality of earnings, which is to get to your normalized EBITDA. So those two in tandem are what's going to come up with that number. Now, the investment bankers who are the ones putting the deals together, they already have something in their minds as well, based on prior experience, as to what certain brands or industries trade at. And so they're taking what's prepared and then trying to push, obviously, if they're on sell side, they're pushing the multiple, as high as they can.
Yeah. Mike, did you?
And I would just add to that, we have, as I said earlier, we have a valuation division as well, also is very robust, and we have dedicated franchise people there. The multiples, there's proprietary data out there that we have access to that actually does rank uh, based on actual transactions that have taken place. It tracks, because when you say comps, everyone can say, well, that's worth this, that's worth this. A company's worth what somebody's willing to pay for it. So the comps are developed based on transactions that have taken place. But you can't just look at these documents. As we said earlier, franchise is a way of doing business. Every industry is different, whether it be the fast food, the QSR business or the gyms. You can't just say, well, gyms go at this percentage. No, because this gym is not the same as that. You may have an Orange Theory and a Retro Fitness and a Planet Fitness, and they, even though they sell, they may be completely different because of how they operate, how the royalties are calculated, what type of investment is needed up front, and how many company-owned locations versus how many operating locations, how old the system is. So we're very fortunate at Citrin that we do have people in our evaluation department that actually understand franchising, understand the differences, and they work closely with us as well because we handle over 200 franchisors. We have a lot of knowledge ourselves as to what's actually going on in the industry within various types of franchise companies. Uh, but to the main point of what PE companies are looking for, many years ago, I've been doing this for so many years, and I remember that PE companies used to meet somebody that's a private equity firm or investment banker, and they'll say, well, the private equity firm is looking at anything that's got $5 million of EBITDA. Okay, they want $5 million of cash flow, or they want $10 million. Don't give me anything unless it's $10 million or more of EBITDA. And in the early days, it was 100% buys. They started reducing that now to less than that. Some of the smaller private equity firms out there are willing to take something that's less. Some of them will say, well, if you have something that's 3 million, there's some that they're not as focused on cash flow as they are as the people in the company. And they're very focused on because they feel they'll bring the cash. They just want to understand what is going to be the burn. And sometimes they're willing to go much less. If you have a company that has $1 million of it or $500,000, there still is somebody there out there for you. Okay. In the old days, Michael Test, even when he first started getting involved in franchising, I think the magic number was $5 million. If you had less than $5 million, don't even come to us. And there's some that said, we'll do a little less. And some tried taking off, but there are a lot of small groups right now. And even the small groups, some of them are excellent. Some of them micromanage. And if you're a franchisor, someone's coming in and micromanage how you operate the business, that's not a good fit for you. So as well as the numbers look, if you're looking to stay on or keep your employees happy after you've gone, which should be one of your criteria, then you've got to make sure you're comfortable with who your partner is going to be. Look, I'll tell you from Citrin Cooperman, we went through a very long process. We had New Mountain Capital was our partner for many years, a much smaller piece of Citrin, but they were our partner for about 3.5 years. We spent a year meeting with so many different private equity firms to make sure that the culture fit, that they had the same vision we did, and what they were looking to do fit in with our people. Our people should be protected, and our people should have an upside. And we've dealt with some very, very large companies that anybody would kill to be a partner with them. And the truth is, we're not saying there's anything wrong with them. They just didn't mesh with where we saw our firm going.
Yeah.
And look, I wasn't part of that, and I say kudos to our C-suite that did a lot of that work. And it has to be done. It really does have to be done for every single company that's looking to go to a PE company. And again,
Yeah.
we're talking mostly on franchisors. Okay, if you start talking about the multi-unit franchisees, it's a lot different. And that actually, at least cake on the multi-unit franchisees, that's critical. Having a good record of what's going on there is absolutely critical.
Yeah.
Whether you have 5 locations, 10 locations, or 20, because a PE company is going to want to ramp up.
Yeah. Well, so there's quite a bit of activity for really smart multi-unit franchisees that are packaging up multiple brands with great operators. You can look at what Capital Spring just did recently, and they've got a track
Yep.
record of investing in that. Sizzling Platter. So building this PE-ready business. I know we were going to be talking about getting organized. Do you feel like, to what extent is lack of organization hindering deal or deal valuation. I don't know, Michael, you want to take that?
I mean that's really all we've been talking about today, right? I mean, if you're it's the Shark Tank questions, right? When you watch Shark Tank and what are you going to do with the money? What's your, what are your key ratios? What were your sales for the last 12 months? What's your cost of goods sold percentage? I mean, these in 20 minutes of talking, a good PE group's going to know whether you're on top of it or whether you're scrambling to put something together. And you want to make a really good first impression. And the more you prepare and know those numbers and know what you're going to do with the money when they give it to you and what the clear plan is for growth, you're already off to the right foot. When they're
Yeah.
asking these questions and you're scrambling around and you don't know any of the numbers, any of the information, you're not ready for basic questions. It's just maybe they'll go with the deal, but they're going to really push the valuation down because they know they have a lot of work to do to get it to a certain spot.
Yeah, exactly. So I don't
Raj,
know. Oh, go ahead, Aaron.
just add to that, you know, we don't expect every one of the franchisors to be accountants and finance people. And the quality of earnings is something that's done outside of how knowledgeable a COO may be in day-to-day numbers like that. But it does put it together. And when the private equity firm comes in or the investment banker brings it to them, they have to do a Q of E before they actually before they give their bid as to what the multiple will be. And it saves a lot of time when they take something we do or somebody has done a sell side one, and all they do is review it. It saves time in the whole process. It also gives you, again, it's bringing out surprises, and I can't stress enough transparency. Okay, if a COO doesn't know some of these numbers off the top of their head, but they have the documents worked up, supported by their actual books and records, that's fine. If they don't have it and they scramble to put things together, think about it. Do you want to get involved with a company that doesn't have a handle on what's going on? You can't make a judgment call or an educated guess as to how much money you can make or whether this will be a good return on your investment. And we all know that the sloppier things are. Look, I'll tell you, I'm embarrassed for it, but some of the large accounting firms or some of the firms out there that have gotten in trouble, okay, because they didn't do simple things like checking out bank statements and bank recs. It's because books and records were messy, and they accepted it. And there's so many things that can be buried in messy books and records, messy documents that aren't there. And nobody should run their business. And certainly if you're selling your business and you don't want to get into some sort of litigation or issues and you want it to be a successful sale, look, we always felt a sale to a private equity firm, believe it or not, we want both sides to be happy. To me,
Okay.
that's a successful sale.
Yeah.
For sure.
Gosh, I know we're talking a lot about PE, but there's debt also, right? So if you're a large multi-unit franchisee and you're looking for a $25 million credit facility, you got to do the same thing here. And a lot of banks at that level will also ask for quality of earnings reports and valuations and things like that. So between the banking and this private equity groups that do just debt.
Yeah,
So
right.
it's
Well,
not
and
just I'm flipping my company. It's like, well, maybe you want 25 million to grow. You got to do the same thing.
yeah, and that's why it's called, private equity and transactions getting
Right.
ready. What is the transaction? Is it debt?
Right.
It'll surprise you, for the last probably 5 years, the number of transactions that have happened between our customers at the push of a button. All the documents are shared from a buyer and a seller. The validation is clean, smarter, faster. Everybody wins, and not just the buyer and the seller, but the lender too, or the transaction broker. Everybody wants to, make sure that all of that time and investment is going to realize into a closed deal where you have success and the triple win-win-win all the way around. So I'm glad you brought that up because I mean markets are tight. Lending is historically tight. I mean, have you seen? Well, there's a question that I actually came across, and maybe this is kind of tied to that. I don't know. Did Nothing But Cakes? There was word that maybe they had a 20x multiple, um, and I don't know if that's the right number or not. But why was Nothing But Cakes at a much higher multiple than some of the others that are maybe 3 to a 12x multiple in EBITDA? I mean,
I mean,
Pretty
that is
broad, kind of
that
maybe
is
it
high,
depends.
but yeah, well, number one, the franchise multiples are usually higher. So there is because of the things we're talking about, free cash flow, brand recognition. So my guess, I mean, it would have been nice for us to work on that deal, which we didn't. But my guess is they had a lot of this stuff lined up, very strong brand presence, very strong management, strong franchisees, strong at the franchisor level, and they checked all the boxes to earn that multiple.
I agree with Mike also, but I think there's more to it. I think they were fortunate to find a buyer willing to pay that. It was worth that much to somebody who purchased them. That's really how it works. And with a lot of companies, look, I know we've got some private equity firms that love buying multi-unit franchise that have large territories. And what happens is they feel if I could buy a 60-unit territory and they only have 5 open, as a private equity firm, I could blow this up. I could turn this into 60 units. The adage was always if I have 1 unit, it's worth one. If I have 2, it's worth 2. If I have 3, it's worth 3.5. If I have 4, it could be worth 6. The more you grow, and private equity firms, it still is the case, even though we find in franchising there's a lot of buy and hold. It was always a 3 to 5 year turn. Now maybe coming to a 5 to 7 year turn, but a private equity firm is made up of investors. Investors want their return on investment, and a lot of that comes from a sale. They get a nice return as it goes along, but their big kick is in the sale. No different than an accounting firm. As firms come in to flip and they look for a flip. And look, we're reasonable. We understand New Mountain came into our firm. We're there for 3 years. They wanted a 3 to 5 year flip. They went after 3. Blackstone is probably here not forever. They're probably going to come in to try to flip as well, try to grow it, watch our firm grow, and then flip it to another firm. That's just how it operates. So when you talk about a value of a company, it's if you've got the numbers, if you've got everything in front of you, and you could show the potential here. I just don't have the cash to build it out, but the potential here, someone's willing to pay that. And my guess is they got 20 times because somebody offered 18, and the only way to get it was 20 time multiple. I just had a QSR deal that we worked on for 4 locations of a particular brand that it was a 5 time multiple, a massive. I mean, this it's a huge investment. I mean, we're talking about it. It was a $25 million deal for 4 locations, and we always wonder when somebody's selling multi locations in a particular area. Very often, existing franchisees would be interested in it. So just to understand, before the PE company goes in there, why these are being sold and what upside there is. But it's hard to take one multiple, say, oh, if they got that, I can get the same multiple on mine. And anybody who was, the Duncans had high multiples, whereas other QSRs didn't. It's also timing,
Yeah.
and I go back to it's what people are willing to pay for because they feel the brand is strong
Yeah.
and the franchisor is strong, and they're heading in the right direction.
I think that, just to sum it all up, I mean, due diligence and preparing is all about risk reduction. How do you eliminate risk in your deal, in your company, in getting that transaction closed? And that's frankly really, why we've succeeded. Um, so I don't know, Michael, why don't you touch on some of the key takeaways? I mean, how do tools like what we offer at Least Cake help you streamline that process, staying one step ahead?
Yeah, so anything where you can track, organize, know exactly what's going on, where all your documents are, what was signed when, what's expiring, things that like you track and that other things track is is key. You have to have that data in place. And one of my key, takeaways here, which I covered a little bit earlier, is your cultural fit. Just because somebody throws money at you, yeah, it's very tempting, but does that mean you can deal in that environment and last in that environment? And is everybody going to stay or are they all going to run out because they don't like the group that came in? So you have to be very careful. You have to culturally align with the buyer. You have to interview everybody. You have to kind of really make sure that everybody's, on the same page with what the future of this organization is going to look like, because that's where deals go bad. Also, bad cultural alignment.
Yep. And the more time you have, well in advance, 2 to 3 years out, the better.
Yep.
Aaron, what's your key takeaways?
Yeah, but Mike touched on them. Obviously, it's a matter of understanding when you do look to sell. Okay, you're selling your piece of the company, but you're selling it with the employees that are still there intact. It's not their exit strategy, it's yours. Make sure it's a situation that benefits the employees as well. I know you may think it costs you more because you're sharing something or you're getting their buy-in, but that's what makes a successful sale. If a PE company sees they've got motivated employees, C-suite that's actually going to stay there, run the company, and they're comfortable with them, make sure that they're part of that deal as well. And look, I know I'm an accountant, so I have to say this, but it is so critical is if you are looking to make any type of exit strategy, whether it's to a family member, to a PE company, or whatever it might be, uh, the tax situation and how you're structured is critical. It may change the deal by millions of dollars. It could blow up a PE deal, and it also catches a lot of people by surprise. You may have bought a franchise system or bought the IP from someone and been amortizing all these years, and all of a sudden realize, hey, I've got all this ordinary income, high rate, 37% tax on all this stuff that you
Sure.
weren't anticipating. Because everyone says, oh, you're selling the company. It doesn't work that way.
Yeah. Well,
So get the right people involved, get the franchise. Again, not firms that do franchising, but people focused in the franchise community. We're so fortunate that there are 600 some odd suppliers that are members of the IFA that are dedicated to franchising, understand franchising, and they continue to learn and work together with other people in franchising, such as this call here.
yeah.
And that's where you want to go. If you're in franchising, stick with franchise experts.
I love it. All right, so we're near time right now. I want to say thank you, gentlemen, but just a couple of other takeaways. Next week we have the COO of Dave's Hot Chicken just got acquired by Roar Capital for $1 billion. Chicken, and that webinar is coming up next Tuesday. So we're excited about that. There's also another webinar coming up end of June, June 24th, revolutionizing facility and real estate management with Mitra QSR, one of our customers, and EcoTrack, one of our partners. That's June 24th. And as I said earlier, we will be posting and sharing with all of our listeners a due diligence checklist, a guide not just for general due diligence that we covered today, but also real estate due diligence. It's going to be really important for everyone to stay one step ahead and get ready. But thank you so much, Aaron and Mike. It was a joy. We could have talked for weeks, I'm sure, fielding some fantastic questions. But hope you guys have a great rest of your week, and thank you all for listening in.
Taj, thank you so much. This was great.
Raj, thanks for arranging this. Appreciate it.
Absolutely. Take care.
Thank you.
Bye-bye.
Bye.